The smartest traders in the world don't trade prices, they trade stories. I mean, think about it. How many times have you seen a project with incredible technology, a doxed team, and a perfect roadmap absolutely flatline? Meanwhile, a token with a picture of a dog wearing a hat, or a ticker that sounds like a sneeze, pulls a 100x in a week. It's frustrating, I know, and it's perplexing. And for all of those trying to apply traditional valuation models to crypto, it's downright maddening. But here is the brutal truth. In the crypto markets, fundamentals are often secondary to the narrative. The story is the signal. We are operating in an attention economy. Capital doesn't flow to the best product. It flows to the most compelling story. And if you could learn to spot these narratives before they hit the mainstream, before your Uber driver starts asking you about AI agents or restaking, you unlock a level of asymmetric upside that simply doesn't exist in any other market. But how do you distinguish a genuine narrative from a fleeting pump and dump? How do you measure the strength of a story? And most importantly, how do you trade it without becoming someone else's exit liquidity? That is exactly what we are going to break down today. We will explore the anatomy of a crypto narrative, the specific on-chain signals that reveal where the smart money is positioning right now, and the psychological traps you must avoid to survive the cycle. My name is Louis, and welcome to Coin Bureau. But before we dive into the mechanics of the attention economy, I need to remind you that I'm not a financial advisor. This video is for educational purposes only. If you want to learn how to read the market like a pro, prove it by punching that like button, and let's get into it. To understand where we're going, we first have to look at where we've been. Because while the tickers change, the psychology behind a narrative cycle remains remarkably consistent. A narrative in crypto isn't just a buzzword. It's a dominant idea or storyline that captures the collective imagination of the market. It explains why a token has value, why it matters right now, and why it's going to the moon.
Perfect.
Take the DeFi summer of 2020. Before June of that year, decentralized finance was a niche experiment. Total value locked, or TVL, was sitting at around 700 million. It was a rounding error. But then a narrative formed. Banks are obsolete. You can be your own bank and earn yield. Compound kicked it off with liquidity mining. Suddenly, you weren't just using a protocol, you were being paid in governance tokens to do it. The story shifted from tech utility to profit opportunity. And the market exploded. TVL skyrocketed from that 700 million to over $15 billion by October. A 2,100% increase in just a few months. Tokens like Yearn Finance's YFI went from $0 to over $40,000, flipping the price of Bitcoin itself. Then we had NFT mania in 2021. The narrative, digital ownership and culture. It wasn't about yield anymore, it was about status. Bored Ape Yacht Club minted for roughly $200. At the peak, the floor price was over $400,000. Why? Because the story of exclusive membership and celebrity adoption drove attention, and price followed attention. Fast forward to 2023 and 2024, and the narrative shifted again. This time, it was the convergence of AI and crypto, fueled by the launch of ChatGPT. Tokens like fetch.ai and Render rallied thousands of percent, not because they had solved artificial general intelligence, but because they were liquid proxies for the biggest story in the world. So, what gives? Why do these cycles repeat with such precision? It comes down to the narrative life cycle. And if you want to trade this, you need to know exactly which stage you are in. Every major crypto narrative follows a 4-stage path: inception, excitement, social proof, and finally, liquidity, also known as the quote-unquote distribution or quote bag holder phase. Stage 1 is inception. This is usually driven by a technological breakthrough or a macro event. Think of the Bitcoin halving. We know it's coming. The narrative of supply shock is built into the code. Or consider the recent rise of modular blockchains in 2025. This starts with developer activity. At this stage, price action is quiet. The only people paying attention are the builders and the deep dive researchers. If you're buying here, you're taking on high risk, but you are also securing the best possible entry. Stage 2 is excitement. This is where the smart money enters. VCs start deploying funds. We saw this in the first half of 2025, where crypto companies raised over $16 billion. When you see top-tier VCs like A16Z or Paradigm pouring money into a specific sector, like they did with DeFi in 2020 or AI agents recently, that is your signal that the narrative is heating up. Stage 3 is social proof. This is the acceleration phase. Influencers start tweeting. Discord servers blow up. The narrative spreads from the insiders to the informed enthusiasts. Prices start to move aggressively. This is where FOMO kicks in. And make no mistake, FOMO is a powerful drug. Academic research from 2025 shows that nearly 68% of retail crypto decisions are sentimental-driven, not technical. We are social creatures. When we see others making money, our brains short-circuit logic and scream at us to buy. Finally, there's stage 4, which is liquidity. This is peak euphoria. Your non-crypto friends are asking you how to buy that dog coin. The media is running headlines about crypto millionaires. This is usually the top. The early buyers, the ones who bought the inception phase, these people are selling their bags to latecomers. Now, there is a tricky part to this. That is that in 2025, these cycles are compressing. Back in the ICO era, a cycle might last 3 years. Now, some of these narratives are playing out in literally weeks. So, how do we identify these narratives before they hit stage 4? Well, we need to look at the data. Thankfully, the blockchain leaves footprints. One of the most reliable signals is developer activity. Real innovation takes time to build. If you see a sudden spike in GitHub commits for a specific sector, well, that could be a leading indicator. Developers are the canaries in the coal mine. They move to where the tech is interesting long before the price follows. Another signal is capital flows. Follow the money. In Q4 2025, we've seen a massive rotation of capital. Smart money has been flowing out of older monolithic chains and into the Ethereum Layer 2 ecosystem, specifically projects like Arbitrum and Base. But perhaps the most accessible signal for us retail traders is social volume. Tools like Santiment and Lunar Crush, these guys track the number of mentions a coin or narrative gets on social media. And so here is a pro tip. You want to look for a divergence, okay? So if the price is rising, but social volume is still low, then you're probably early. That is the sweet spot. But if social volume is exploding, if AI crypto is trending #1 on Twitter, for example, and the price is stalling, well, that could be a warning sign. It means that everyone who wants to buy has probably already bought. And speaking of AI, let's look at what is dominating the narrative landscape right now in November of 2025. Because if you are watching this, then you want to know what's next, not what happened a few years ago. The data is pretty clear. The dominant narrative of late 2025 is the convergence of AI agents and crypto. In Q1 of this year, AI agents and meme coins accounted for over 62% of investor interest. We aren't just talking about tokens that have AI in their name. We're talking about autonomous agents, software that could transact on-chain, manage wallets, and execute strategies without human intervention. The market cap for AI-related tokens is hovering around $25 billion. That sounds like a lot, but compared to the broader market, it's still early days. Projects like BitTensor and fetch.ai are leading the charge, but the real alpha is likely in the infrastructure plays that allow these agents to exist. Another massive narrative is restaking. Eigenlayer is one of these cryptos that actually changed the game. It allowed Ethereum stakers to use their ETH to secure other protocols. This narrative of capital efficiency, earning yield on top of yield, drove Eigenlayer's TVL from $1 billion to over $18 billion. It's the same psychological driver as DeFi Summer, which is yield. And finally, we have real-world assets, or RWAs. This is the institutional narrative, and one that I personally like. When BlackRock launches a tokenized treasury fund and it hits $500 million in market cap, the market pays attention. As of this month, there are over $35 billion in tokenized real-world assets on-chain. This isn't just retail speculation anymore. This is the plumbing of global finance moving onto the blockchain. The narrative here is legitimacy. Now, identifying the narrative is only half of the battle. You also have to know how to trade it, and that requires a plan. But before we get into the specific strategies for building a narrative thesis, there is one essential tool that you need in your arsenal if you want to take advantage of these opportunities. If you are looking to position yourself in these emerging narratives, Whether it's picking up some AI tokens, driving into the RWA ecosystem, or just stacking more Bitcoin, you need a reliable place to trade. And the best way to do that is by checking out the Coin Bureau Deals page. We have curated the best sign-up bonuses, fee discounts, and exclusive offers from the top exchanges in the industry. We are talking about deposit bonuses of up to $100,000, trading fee discounts of up to 50%, and cashback offers that you won't find anywhere else. Whether you're a seasoned trader looking for better liquidity or a newcomer just setting up your first account, these deals are designed to give you a head start. This market moves fast, and you don't want to be setting up your accounts when the candle is already green. So hit that link in the description or scan the QR code on the screen right now. It helps support the channel and put some extra crypto in your pocket. These offers change regularly, so make sure that you take advantage of them while they still last. Okay, so you've identified a potential narrative. Maybe it's Bitcoin DeFi or DePIN, Decentralized Physical Infrastructure Networks. How do you build a thesis around it, though? You need to think like a venture capitalist, but trade like a sniper. Step 1 is to connect the story to fundamentals. A narrative without fundamentals is just a bubble waiting to burst. Look at the DePIN sector. The story is real-world utility, but does the data back it up? Currently, the DePIN sector has a market cap of over $50 billion, growing 270% year over year. There are over 5.7 million devices deployed globally. That is fundamental valuation. The story aligns with the reality. That is a strong thesis. Step 2 is to check the tokenomics. This is where many traders get wrecked. You might be right about the narrative, but wrong about the token. If a project has massive unlocking schedules, where early investors get millions of tokens released every single month, that selling pressure can crush the price even if the narrative is bullish. So you should always check what's known as the float. If only 5% of the supply is actually circulating, you're trading a musical chairs game. What you want to see is a healthy distribution so that you aren't the one holding the bag when the VCs cash out. Now we go on to step 3, which is timing and psychology. This is the hardest part. You have to fight your own brain. We've all heard, buy the rumor, sell the news. But in narrative trading, it's more like buy the confusion, sell the euphoria. When a narrative is in the confusion phase, where people are trying to figure out what restaking actually means, that is usually your best entry. When your Twitter feed is nothing but rocket emojis and the price targets of $100,000 come to play, well, that's your signal to start scaling out. And this brings us to risk management, because let's be real here, we're often wrong. The golden rule of narrative trading is position sizing. You never want to risk more than 1 to 5% of your total capital on a single speculative play. If you are betting on a microcap AI coin, that should be a quote-unquote satellite position in your portfolio, not in the core portfolio. A common framework is the 60-30-10 split. 60% in high-conviction blue chips like Bitcoin and Ethereum, 30% in narrative-driven plays like the mid-caps that capture the current trend, and 10% in moonshots or cash for buying dips. This way, if a narrative collapses, like the way we saw with many metaverse tokens and a lot of other narratives, you aren't wiped out. You live to trade another day. You also need an invalidation point too. Before you enter a trade, you should ask yourself, what would prove me wrong? Maybe it's a drop below a certain support level. Maybe it's a decline in developer activity. Or maybe it's just that the market stops caring. Some invalidation signals that we found in our research are if Google trend searches for a certain narrative, if they just fall off a cliff, or if quote-unquote smart money wallets, if those flows turn negative, then the story might be over. The key is that you just don't want to marry your bags. The market owes you nothing, and we need to remember this. And this brings us to a crucial concept, which is the attention economy. In 2025, we are seeing a shift. The correlation between, quote, narrative attention and price is higher than ever. Academic studies have shown that a bidirectional flow of information exists between search trends and crypto returns. It's a reflexivity loop. Higher prices generate headlines. Headlines generate attention. Attention brings in new buyers, which drives prices even higher. This loop is what causes the parabolic blow-off tops that we love. But it works in reverse too. When attention fades, liquidity dries up. And in a market dominated by algorithms and high-frequency trading, that liquidity vacuum can lead to brutal crashes. We saw this on October 10th of this year, when $19 billion in open interest was wiped out in a single day. The narrative of up only collided with the reality of leverage, and the result was a bloodbath. So, what's the key takeaway here? Well, it's that in trading narratives, it isn't really all about the hype. It's about understanding human behavior. It's about recognizing that the market is a collection of people, and now AI agents, all chasing the same thing, the next big story. You need to be a macro storyteller. You need to see the why behind the charts. Why is BlackRock buying RWA? Because institutions need yield. Why are AI coins pumping? Well, it's because AI is reshaping the global economy. Why is Bitcoin hovering around $85,000? Well, it's because the halving supply shock is meeting institutional ETF demand. These aren't coincidences. They're chapters in the same book. So, let's bring all of this together. The crypto market is evolving. We have moved from the Wild West of 2017 to the institutional adoption of 2025. But the core mechanic remains the same. Price follows narrative. Narrative follows attention. If you can master the art of identifying these stories early, tracking the developer commits, following the VC funding, and gauging the social sentiment, you could position yourself before the crowd arrives. But you must remain disciplined. You must recognize when a story has run its course. And you must never, ever let FOMO dictate your strategy. But what do you think? Which narrative do you think is going to dominate 2026? Is the AI bubble just getting started, or are we about to see a massive rotation back into the DeFi sector, or maybe real-world assets, or something else? I want to hear your best thesis in the comments below. And if you want to dive deeper into the specific AI projects that we are watching right now, well, then you need to check out our video on that right over here. Thank you so much for watching, and I'll see you again very soon. It's Lewis, signing off.